Okay, boys, let's get moving here. We're going to do the basics of candlesticks. Now, this is going to go over exactly how candlesticks are formed, what they mean, and give you a basic overview to hopefully help you in life understand price and why it's so important in trading stocks. First up, here's 4 books, which are great references. The first one up top is the Edwards and McGee book. Been around for a long time, one of the classic technical analysis textbooks. The one book I've probably read the most of is these two down at the bottom. The first one I read was Technical Analysis of Financial Markets by John Murphy. Excellent book, goes over the basics. And then the one that's been most important recently is this Japanese candlestick charting techniques, because it goes into the history of how the Japanese came up with candlesticks, what they mean, and how it goes all the way back to I don't know how many thousands of years ago with the rice traders in Japan. And then finally, kind of putting it all together, this Trading Tools and Tactics book takes pretty much all these 3 books and kind of says, okay, now how do you actually trade? So all these are great books I recommend you pick up as references, and everything I'm saying is covered in these books. I'm just trying to make it simple for you guys. Okay, let's talk about why candlesticks. Well, first off, here's an example of what a typical line chart, if you went over to Yahoo Finance and just typed in Tesla, you'll get just a basic line chart. And what it shows you is for whatever time period you select, it's going to show you the only one piece of data, which is close price, which if you pick a daily chart or whatever time frame, then it would be whatever the close price for the day. If it's an hourly, it would be close price for the hour. But the point is, it just gives you one piece of data, just one point, which is close price. And that's great, but it doesn't tell you much. It's almost kind of like looking at the scores of a football game, and you see just the final score. You see, okay, in this chart, you see the Bulls versus the Bears, and the line chart gives you one piece of data, which is the final score. But a candlestick chart can give you, with one image, can give you a lot more information, almost as in like what was happening throughout the course of the football game. So when you saw this final score of 35-31, the Bulls won, you go, oh wow, it's a really close game. Maybe I should watch it. Watch the recording of it. But when you look inside and you see, well, actually no, that was maybe, let's call it a preseason game, or they had all their starters in and the Bulls were just kicking their ass, and then they at the final quarter they said, hey, let's put our bench warmers in and get the starters some rest, and then all of a sudden the Bears came back and got pretty close. So you could decide, okay, was that a close game or was that not a close game? I'm not really sure, but you wouldn't know until you actually looked at quarter by quarter what was going on. And that's kind of what candlesticks give you, is the ability to kind of see what was the high, low, and then open and close price. So let's look at those pieces of information. So here is a just basic overview of how a candlestick works. So on the left we got the Bulls, and on the right the Bears. But so a green candle or a white candle, depending on how it's printed, is a bullish candle. The high is up here at the top of the what they would call the candle wick, or the wick, or the shadow is what they also call it. The close is up here. It opened up here, and its low is down here at the bottom. So it opens here and it goes all the way up and closes. Now if it shoots up and then comes back down, that would be the high. Here's the close, and vice versa. It shoots up, comes down. Oh, here's the low, up, goes all the way back up, closes. Same thing on the red candle, except because it was a negative, right? The close was lower than the open, right? It went down, so it opens up here and then it drops, and it closes down here at the bottom. So immediately when you look at these 2 images, you can see, well, I know what the high price was, it's up here. I know what the low price is. I know that it opened up and the Bears won, so it closed lower than it opened, or vice versa. So right there you get 4 pieces of information with one image. Okay, so let's go back in time just briefly to kind of give you a little bit more perspective on how this works. So back in the olden days, here's some pictures from I think 1918. Um, you had these ticker tape machines, and that's how price data was transmitted to different market participants like brokerage houses and whatnot. And I'm sure it was probably like Morse code or something very simple. But you have these machines that are clicking off all the prices on what they call a ticker tape. And the tape is just like a long roll of paper and just keeps printing off prices. And so essentially what we're doing is we're just taking these prices as they're coming off the ticker tape, and we're just slicing it up in different time slices, whether it's by day, hour, 15 minutes, 30 minutes, however. And the key thing to understand is that the data is not changing. It's just continuously coming, and we're just looking at it in different time slices just to kind of see how it's moving over time. And so because of that, the candlestick analysis works on any time frame that you choose, because the patterns are just the same. It's meaning that all you're seeing is price data. It's just how you're slicing it and looking at it. So no matter how small we make the time slices, the patterns the patterns are still the same because the data hasn't changed. We're just looking at the patterns, like zooming in with a microscope and then zooming back out. So let's go back to our football game analogy, and let's just assume that each quarter is 15 minutes with a full game at 1 hour. So on the right hand side in our Bulls versus Bears football game, you see that we have this big long bullish candle, which indicates that we opened and then we closed higher than we opened. And in this case we see no shadows or wicks on this candle. So let's look at what could have been some possible 15-minute quarter candles that produce this 1 hour final candle. So you can see in the first quarter we had the kickoff, the Bulls go down, they score a touchdown, and the Bears get shut out in the first quarter. So it's 7-0, which means the Bulls came out and they scored, and we closed that candle. Bulls are up 7-0. Second quarter, the Bears are fighting hard, so the Bulls only get a field goal, but we still have it 3-0, so we have a smaller body candle here. And then they go into halftime, come out, Bears put up a good fight, Bulls put up some points, it's tied 7-7. So in this case you see that we have this narrow body bar, this what they call a doji, where it basically opens and closes at the same point essentially. So we have the Bulls went out and they got some points. The Bears came back down and answered, and it was a tie essentially. And in the fourth quarter, the Bulls come out and shut them out, so they get 14 points to seal the deal. And overall, we have the candle opens and closes higher than it opens, therefore it's this bullish candle. So these 15-minute quarters could have been multiple different things. This is purely just an example, but this is what it could have looked like. Here's another example where the Bears win. The Bears win this one 42-10, right? So that means that the market closed lower than it opened on this day or this hour. And let's look at our 15-minute quarters to see what could have happened during this 10-42 loss to the Bears. First quarter we came out, it was even, right? We opened, we went up and scored 7 points, came back down, scored 7 points, it was even, so it was a draw this quarter. In the second quarter, same thing. Bulls come out, put a field goal up, it's 3-0. Go into halftime, Bears get pumped up, they get a great motivational speech, they come out, open the game, or open the half, boom, they put 21 points on the board. And then same thing with that momentum going into the fourth quarter, boom, another 14 points on the board. And now we see, in this case, we opened the hour, the Bulls came out to a lead, but they lost that lead, so we ended up closing lower than we opened. And so that's what that looks like. Here's a different example. This one was a much closer final score of 35 to 31, like we were talking about earlier. But let's look at how the candles shaped up at the 15-minute slices. So bulls come out 21 to 0. Second quarter was scoreless, so we don't even have any shadows on this bar. It just opens and closes at the same point. Momentum shifts to the bear side. Now we see that there's 3 points on the bears. And finally, we see in the fourth quarter, the bulls put up a good fight, or bears put up a good fight, rather. But overall, we closed down here, so we can see we closed higher, so the bulls won, but you had this big battle where it looks like the bulls were in full control, but they really weren't. This is a situation where you would say it's actually, even though we closed higher than we opened, it's actually a very bearish candle, and we'll go into what these different candles mean. But this is kind of give you an example of what it looks like, in real time, the way these things would kind of shake out. Okay, so this last one, let's do a quick test and see what you think this final bar is going to look like. So we open up the game, first quarter, bears come out, put a field goal up. It's 3-0 bears, so we can see we opened and then we are closing this bar lower. Second quarter, same thing. Bears come out, put 14 points on the board, so we opened the candle and we closed lower than we opened. Go into halftime, come out, bulls get a pep talk. They start putting some momentum together. They score 3 points. That gets them excited. And then in the final quarter, evidently the bears just gave up. And so you have this huge candle at the very end of the game. Boom, opens, closes way higher. So what do we think that the final candle is going to look like? Boom. There you go. So you can see we opened here. We dropped all the way down because the bears were winning, but then the bulls came through, closed higher than we opened, so you have this long shadow underneath, and then you have the final score up here where we closed higher than we opened. Okay, so this entire presentation, everything I've talked about thus far, was leading you to this chart, to this. This really is the meat of what I wanted to talk about, to kind of really help you understand the sentiment and the psychology behind each of these bars. So when you see them, at least you think into your mind, okay, this is what the psychology is. So up top we have the bulls, at the bottom we have the bears. And let's go over candle by candle the sentiment behind each bar and why that is. So this first one, the most bullish bar, or the most bearish bar, you'll see the inverse on the bottom is exactly what we have here. The bullish bar is 100% bullish because it opens and then closes higher without any retracement or any shadows on the candle. That means it opened, closed higher, the battle is completely won by the bulls. The second most bullish bar, and its inverse, which is the second most bearish bar, may not be obvious. Why is this one the second most bullish? The reason why is because this candle, when it opened up and dropped like this, it essentially was looking like this candle guy down here. He was like this, with this gone. So it opens up and it drops all the way down, but then we go into halftime, and the bulls came out and they bought all of this back, right? And then we finished higher up here. So what that shows you is the psychology of the bulls was so powerful that even with that big red bar of all that selling, the bulls came in and bought it all back and then bought it and bid it up higher than it opened. That's extremely bullish. That's like going into halftime, coming out, you put in, Brady and whoever, and they come out and put up 50 points and win the game. That tells you that that team has a tremendous amount of fight and psychological, mental toughness. Okay? Now, the middle candle is pretty obvious. It's the normal bullish and normal bearish. That's pretty obvious. Hey, big green body, big red body, whatnot. We get to the fourth bar here, the neutral bar, This is most of the time called a doji bar. This is essentially the bar opens and closes right around the same price. I've been looking at a lot of different dojis, and the definition is it needs to open and close at the same price, but it's very rare you see one where it's an exact line. So I would say, you look at the stock price and kind of figure, how much price movement would make that a neutral bar, a doji. Maybe it's $1, maybe it's 50 cents. I don't know, but bottom line, it needs to be a very narrow body bar. And what this indicates is basically a draw. It's a tie. It's basically indecision, meaning the market participants don't know if it's going to go up or go down. Some think it's going up, some think it's going down. Overall, people don't really even know. They're just kind of guessing. And this last bar is the least bullish and the least bearish. And the reason why is it's really the inverse of this second most bullish and second most bearish. So for the bulls, we open up the game here, and basically what this candle used to look like was a most bearish candle. So we'll move that guy over there. So it used to look like this. And then the bears came in and ate it all back, or sold it all off, rather. Bears meaning they eat. So, and it did this. So it went up, opened here, went all the way up, and then the bears sold it back off so that we ended up here, right? And vice versa down on this end. Is that we opened up the game, and we opened up here, right? So it used to look like this, but then the bulls came in and bought it all back, and so what we're left with is this shadow. Okay, we're in the last couple of charts here. I would be disappointed if I didn't go into at least a little bit about the doji candle, because this candle is a very important candle because it recognizes that there was a draw there between the bulls and the bears. It's called the doji candle, or the narrow body bar, or the neutral bar. So in this case, we have an open and close right around the same price, indicating that the bulls bought, the bears sold. Somewhere we ended up basically where we started. This means different things on different time frames. It always indicates some sort of indecision, and it typically, but not always, precedes a sell-off. So if you look at big sell-offs, call them corrections or even bear markets, go back in time and you'll see a doji. Most of the time, you'll see a doji somewhere right before that happened. It may not be the immediate bar beforehand, but it is definitely a warning sign, because it shows that the buyers and the sellers are confused on which way markets are going to go. And so one of the reasons that it precedes a sell-off is because it indicates indecision. And when people are indecisive, they typically move to cash. Because if you are in Tesla and you're not sure if it's going to keep moving up, first thing you want to do is get out. And so if you think, well, maybe it's going to go up, maybe it's not, best thing to do is be safe, move to the sidelines, move to cash. So that's called selling. Okay, so in closing, for the doji, is I believe a doji is a bearish indicator, because of the fact that when people are indecisive, they typically sell and move to cash. So that's why a doji typically indicates that there's something big coming on the bear side, because people don't know which way it's going to go, and so they're just going to move to safety. And we are at the end of this, and I want to just briefly show the references again. Be mindful that this isn't the Closet Caveman's own analysis per se. Most of this is from all these different books, and I recommend you read them so you get more of a professional perspective on this. But keep in mind that at the end of the day, it's your money that you're trading, and you're the best expert on that.